URNM. It's brand new. It's only a month old, but it's very small. So if you use a new fund, obviously you want to use a limit order. But the goal of this fund is to track uranium companies, mostly the miners, though. So here we are at the holdings. And these top 3 companies here, all totally uranium mining. Some mining ETFs will have diversified miners, but this is pretty pure. And that's really the differentiating factor with this new uranium mining ETF, is to get as close to the price of uranium as possible and go further. That means more volatility. So let's look at a tail of the tape between this one and URA, which is the existing one, and also NLR, which is the other one. Now, URA is very old, 9 years, pretty sizable, given the performance has been like awful. But here's the big difference. Look at the percent mining companies, 75 for the new one here, 45 for URA, and 4 for this. These will be a little less volatile, but this should pop more if uranium goes up. A little pricier too. So that's generally what you're getting here. But again, it's a fresh new ETF, so beware limit orders. But this is a fascinating issue that we could hear more about in the future.
All right, good stuff, Eric. Now, still with us is Tim Rotolo of NorthShore Indices. And let's talk a little bit about this idea of a new uranium ETF. Why did you decide to launch one? Because Eric mentioned the not-so-great performance. It's pretty miserable, actually, for the past decade, if you look at URA. The back test for URNM, I'm guessing, can't be that much better. So what's the investment case right now?
Yeah, so over the last couple of years, the domain expert who oversees the fund with me, Mike Alkin, has put together a thesis that I just think sets uranium up as one of the most asymmetric investment opportunities in the market. So candidly, I hadn't even thought about it as a back test. I mean, we just knew that the market's been in a bear market for almost a decade. The fundamentals are continuing to set up incredibly favorably. So demand growth from nuclear utilities is very, very robust. We think it's going to grow 2% for the next decade. And on the supply side, we think that there's a supply deficit forming. And so, from my perspective as a generalist investor, when I thought about investing in uranium, I saw URA had basically changed their index in 2018, and so that created an opportunity where there was no longer a way for investors to access this opportunity set. And so we decided to set out and create the index. We also wanted to tilt it towards junior miners because we think that that's where the real operating leverage is in this opportunity.
There's an op-ed this month in the Wall Street Journal talking about how nuclear energy can save the planet. Climate scientists, the author of this book, tell us that the world must drastically cut its fossil fuel use in the next 3 decades to stave off potential catastrophe. Confronting the challenge is a moral issue, yes, but it's also a math problem, and a big part of the solution has to be nuclear power. The problem, though, Tim, is public perception. Chernobyl, 3 Mile Island, Fukushima. How much will it take to change the perception that nuclear is not safe?
I'm not sure it's going to happen overnight. I think that's actually what's one of the opportunities in this sector, is that the public perception is so negative. And actually, there was a Pew Foundation poll which showed the favorability of nuclear is akin to coal and other dirty fuels and fossil fuels, whereas wind and solar are incredibly favorable. It's 96, 97% favorability. So I think the actual opportunity is that we're starting to see that shift. And so actually the change of direction of the sentiment is going to be very positive. And we've already started to see that as nuclear demand growth has accelerated over the last few years.
And then real quick, you have this other ETF called Dual that only tracks companies that have dual share class listings, which ESG people aren't really hot about because it gives too much control. What's the logic there?
So again, we see that there's a void in the market, no different than private lenders who moved into non-bank lending after Dodd-Frank. The index providers like S&P have said they're not going to provide or not allow dual share class companies into the S&P 500 and other indices that they manage. We think that there's an opportunity to provide access to dual share class companies, which, when you look at a more favorable back test, have done exceptionally well. And we think it's actually somewhat antithetical to the capital markets to exclude investors to be able to not to be able to invest in companies like a Google or a Facebook. So, if you're truly trying to democratize access to capital markets, I think we have to be able to provide an investment solution to investors to have access to those dual share class companies, which have been some of the most prolific growth companies of the last decade.